I mean, you can't find fault with a report where the earnings per share whipped the estimates by 15 cents. Revenue was way up compared to estimates and last year. It looks like the nitpickers are picking a nit over your guidance.
Yeah, I think that's a good characterization. So what we reported this morning, revenue for the quarter, and this was the end of our fiscal year, so we just reported the fourth fiscal quarter. Revenue was up 11% on a GAAP basis for the quarter. Operating income up 20% on a GAAP basis. We set a quarterly sales record, all-time sales record in the fourth quarter, and for the year, we set an all-time annual sales record. And as I reported this morning, our sales pipeline is larger than it's ever been in the history of the company. So a really excellent performance for the quarter and for the year for our company. There was, and then we issued long-term guidance this morning, top line 7 to 8% per year for the next, for the foreseeable future. And then we shared 20 to 40 bips in margin expansion for the foreseeable future, not for the next fiscal year, but kind of as we take a longer term view.
So why are those Wall Street meanies punishing you?
So a couple of things that I think have caused some confusion, and we'll just have to see how the next couple of days settle out. There were really two big things in the guidance that I think has confused some people. One thing is we report every quarter on what's called deconversion revenue. If one of our customers is acquired, we rarely sell software. Most everything we sell is recurring revenue in nature, so long-term contracts. If one of our customers is acquired by another financial institution, they buy their way out of the contract. That's called deconversion revenue. Deconversion revenue is very unpredictable, and it's not a reflection of the operation of the company. And so we announced this morning, we're going to change. We actually did an 8K a couple of weeks ago, but we talked about it this morning. We're going to change the way we report on deconversion revenue because it's not a reflection of the operation of the company. I think that has kind of confused some people, and they're working through that model. The other kind of significant impact to the guidance was we announced a program that we called Voluntary Early Departure Incentive Program, which is essentially a program for long-term employees to leave the company early, retire, if they've been at the company for a long time. And that will produce some expense in the first fiscal quarter of this year. And so we talked about that. So I think people trying to work those into their models and figure out what does the future really look like for Jack Henry is what you're seeing today. But as I said, our pipeline is larger than it's ever been in the history of the company. And we're a 47-year-old fintech. So really, things look very promising right now as far as I'm concerned.
I have to say, you gave me a very candid answer there. I appreciate it, and I appreciate you coming on today. It's not every CEO who would choose to do that on a day where the stock is taking a little bit of a swoon. Let's talk about the market you serve, or the markets you serve. And they are small and medium-sized banks, and those banks have been well, they've been targets of Moody's, and some have been downgraded. They've been in the news. Some of them have gone bluey, and there's been sort of an odor that has attended to some of them. Let me put it that way. How's that affecting you and your business?
Yeah, so it's been an interesting 3 months. In fact, I saw you on with Frank Holland just before I came on. Frank interviewed me the day after the Silicon Valley Bank weekend happened, and we were talking about this back at that time. The good news for Jack Henry is we serve all those middle market banks and credit unions, by the way. So we, by strategy, choose not to serve the top 10 banks in the country. We also don't serve the little tiny banks and credit unions. It's that middle market is really our bread and butter at Jack Henry. And if you look at those customers, although there have been debates between Moody's and Fitch about ratings and so on, their performance overall has really been pretty good. We saw a survey in late April regarding deposits, for example. 77% of customers in our space reported no really significant inflows or outflows, and 9% reported inflows of deposits into their financial institutions. They're well capitalized, well run generally. They're kind of the lifeblood of Main Street America, if you will. And they've been largely unaffected by what happened with the meltdown of Silicon Valley Bank and the others. But, they've been penalized a little bit. And so guilt by association, I guess, Jack Henry serves those customers. We've been kind of attached to some of the concerns that are happening in that space. But our customers are continuing to spend money, continuing to look at contracts with Jack Henry. So it really has not had much of an impact on us or our customers.
Yeah, when we talk to some of the CEOs of mid-sized banks like WaFd, Brent Beardall there, and Valley National, they're doing very nicely. They're not reporting distress at this point.
No.
So
no, and when you think about those customers, so if you look at our customer base, 60% of small medium business loans written in the United States are written by the customers that we serve. 80% of ag loans are written by the customers we serve. Those customers, those medium-sized financial institutions, really are the lifeblood of Main Street America. And if you look at what's going on overall today, as far as small medium business health, things are pretty good for our customers, and they anticipate that the future looks pretty bright for them right now.
All right, David, we're going to leave it there. David Foss, thank you very much, CEO of Jack Henry. Appreciate your time today.